Hello everyone and welcome back into the channel. My name is Brent and in today's video we are going to be doing our M1 Finance Roth IRA monthly recap. Now it has been a few months since we've done our last recap back on March 2022, so it's been about 3 months. In this video we're going to hit up 4 areas. Number 1, the overall performance of our M1 Finance portfolio. A lot of portfolios out there who were pretty much green for the last several years have begun to turn red. So if you guys are having a portfolio out there, it's still green, let me know down in the comment section. If you guys are having a portfolio that is dipped into the red, I'd also like to know, sharing is caring. So I think that's pretty fun and interesting to kind of share our performances. Number 2, we're going to go into the monthly performance versus the indexes. So how does our M1 Finance portfolio over the past month compared to the S&P 500, Dow Jones, NASDAQ, and such? We're going to go ahead and take a look at that. What were our top 3 winners and losers for the month and the overall performance of the S&P 500 on that monthly basis? Then number 3, we're going to dive into the monthly activity. What did we buy? What did we sell? What dividends came in? I don't know if we made any sales, but I do know that we made some buys and we received some dividends. So we're going to go ahead and dolly all that up. And then finally, number 4, the overall thoughts over the next few months. There's a lot of stuff to hurry up and wait for, so we're going to go ahead and kind of cover just a few things that I have on my mind overall the next few months, right? So that is what we're going to be covering in this video. There will be timestamps down in the description below and in the pinned comment. So this video should be kind of segmented up by portions. So if you guys have any comments or questions for me, let me know down in the comment section below. Otherwise, if you guys are brand new here, subscribe, make it gray, hit the bell to be notified every time I release a brand new video, and give this video a big old thumbs up, and let's go ahead and get into the video. So one big thing that's out there right now in the market, that the S&P 500 now has had its first worst half of the year since the 1970s. So that was over 50 years ago. It hasn't fallen by as much for the past 52 years, right? So that's just a pretty shocking headline right there. It's got a lot of investors a bit more fearful, right? But the big old quote that's out there is be fearful when others are greedy. No, be fearful. Yeah, be fearful when others are greedy and be greedy when others are fearful. So this is a perfect opportunity where the markets have pulled back quite a bit, and not only the markets, right, but that just kind of showcases that companies within the S&P 500, Dow Jones, NASDAQ, that those are down double digits by multiple double digits. So look for opportunity out there in the market, especially in this time, because you're not investing for, tomorrow, next week, next month, next year. Potentially, a lot of you guys out there are like me, who are investing for the next 20, 30, 40 years down the line, where we begin to hit retirement. And, even then, we're not going to be fully out of the market until, the end date, right? Until our end date. So that's pretty much out there on the headlines. Now, jumping over into the investing tab and taking a look at number 1, the overall performance of our portfolio. Now, we are still afloat. Here, we have a total return here of 47.47%. So got lucky, 47 on our side. And our market gains still remain positive. I've seen a lot of positions out there in the market where over the last several years, they had been up thousands, if not hundreds of thousands of dollars. And over the course of the last few years had been heavily invested in more growth, speculation companies, whereas I kind of stuck with my gut. And this portfolio was completely designed around dividends, paying out dividends, dividend companies paying out dividends within this dividend portfolio. The dividends would then rebuy back more shares, and that was going to kind of continuously compound within the portfolio, not only my $6,000 towards my Roth IRA, but also the dividends reinvest in themselves and just being able to buy back more shares. That was the total plan of this portfolio, and I haven't ever changed my sort of strategy within this portfolio. So everything still remains pretty green overall. And if we take a look at the video over where we were at, right, back 3 months ago, our portfolio, 3 months ago, we're sitting at $42,081. So 3 months ago, and versus where we're at right now, we are down slightly. I can't go back a quarter, right? 3 months ago, since I released that last video, we've lost roughly 9% of our total return. But overall, I feel like we've done decent. I think we've done decent overall. So we're down a little bit here over the last quarter, but I think we're still kind of chugging along very nicely over the top. Our top performers here, if we go ahead and scroll this, Apple being up number one, 199%. These percentages, I'm not sure how accurate they are. I think they're with capital gains and dividends that they paid out kind of included within the percentage return. AbbVie is our second placer at 119, Pfizer at 101, and the list kind of trails off from there into the double digits for after there. And our worst performers down here, Clorox here, continues to remain our worst position that we've invested in. But hey, IIPR is following up right behind it very closely and may soon overlap it. We will see. Stanley Black & Decker is in third. Starbucks, Digital Realty Trust is up there as well. JP Morgan and Waste Management. These two positions are positions that I'm kind of building up. If there's any positions right now that I'm invested into on a weekly basis, just kind of dollar cost averaging, they are Waste Management and JP Morgan. I'm also slowly dollar cost averaging. I bought a little bit of IIPR, but we'll kind of cover that here in the activity. So that is our overall performance. Now, on the monthly performance within this portfolio, in the month of June, as of May 31st, 2022, we are down roughly 4.08%. Now, if we compare this to, say, the S&P 500 over that same time frame, it is down roughly 8.39%. So the market did take a little bit of a harder hit. Even if I were to remove the earned dividends out of here, we would still be within the 4% negative percentage versus, anywhere near what the S&P 500 has lost. The Dow Jones here is down 6.71% on the 1 month, and the NASDAQ is down 8.71% on the 1 month as well. So the June month definitely took a really, really hard hit over the past 1 month. And we had looked at the quarter here over the past 3 months here, and we kind of did a comparison of where we were at in our previous video 3 months ago, 42,000 versus where we're at right now. If we take a look at the quarter here, if we take a look at the 3 months here on as well, the indexes here over the past 3 months are down double digits. So the S&P 500 down 16.45% and down 20.58% over the last year to date. So a lot of the losses have taken place over the last 3 months within the indexes here. The Dow Jones down 11.25%, the NASDAQ here down 22.44%, and the Russell 2000, if we look at the 1 month, down 8.37%, and last quarter 17.49%. So our portfolio, it's down 9%, but we're still within the single digits, and overall we have done decent. Even if you took away the earned dividends that we made over the past 3 months, we would still be within the single digits versus the double digits of the indexes. So overall, we're still doing fairly well there as well, both in the past quarter and in the past month. Over the past month, our worst performers. We'll go ahead and we'll go ahead and take a look at the best performers and worst performers over the last 1 month here. So Siggy Selective Insurance is beginning to climb as rates climb. Insurance, health insurance, term insurance, all the rates on insurances are beginning to steadily climb. I've seen a lot of comments out there in the forums and Facebook groups and stuff discussing insurance policies rising as they go to renew their car insurance and their health insurance policies. Everything is beginning to rise. So as interest rates rise and insurance groups are all beginning to raise their rates to kind of match that, I think a lot of the insurance companies, eventually the financial companies will kind of begin to pick up. Anything that kind of benefits from rising rates, I think will benefit really well. So this could be a good time to look at like companies like Aflac. That's the one of the insurance companies that kind of comes to mind. Geico is owned by Berkshire, so you have to buy Berkshire to kind of get a piece of that, but then you get a piece of everything, right? Over the past month, also AbbVie here, 2%, Colgate, 1.62%, and then it kind of just goes into Main Street and Cisco. There's not a lot of what's it called? There's no sector that's very sticking out here. We have insurance, healthcare, what's consumer defensive, BDC, And distribution, I guess this would be consumer defensive as well, Cisco Corp. And then just a lot of red. But overall, we are down 4%. So our worst performers down here, IIPR, this one just fell off a rock. It just said, hey, I'm just diving off into the deep end. Don't even worry about, attaching a line to me. It just kind of sunk down pretty sharply. JP Morgan followed right behind at 14%. Lowe's here, they missed their numbers. And they just said, hey, we're not going to be meeting. I think they kind of lowered their guidance. That's what kind of hit them really hard, saying, hey, we are seeing signs of inflation kind of hurting our prices, and customers aren't coming in as often. And that's going to happen with any sort of business that relies on consumers and spending, which is just about everyone, right? So I'm not going to beat on that. And then we have Lowe's here down 12.5%. And Home Depot, Lowe's are kind of within that same group. Mortgage rates are rising. People are wanting to spend less money on just consuming. So things that are house projects are put on the back burner. So anything Lowe's, Stanley Black & Decker, that just automatically, cuts into their income. And then we have just everything else in here as well. It's kind of a mixture. There's really no safe place here in the market outside of just a few positions that were pretty positive. So I think I'd be kind of looking out there for insurance. Like if I were to kind of focus and look around for maybe opportunity, I feel like insurance would be semi-decent. So this could be a pretty good area to kind of look for other companies within the insurance sector and look for opportunity there if I were to look for a specific group. So that is our number 2, the monthly performance in comparison to the indexes. Let's move on to the activity tab. So clicking up at the activity, let's go ahead and select our range from the 1st of June till the very end of June. We don't have to worry about the end of June. We're going to go ahead and focus here on dividends first. Let's go ahead and select dividends only. This is a really nice feature of M1 Finance with just being able to select dividends there. I don't believe they used to have that in the past, but I'm really happy that they added it in now. So let's go ahead and add all these dividends up right here. From top to bottom, we have Siggy Selective, $6.20. This is a quarterly paying company, so they pay out $6.20 to me every single 3 months. We had J&J, $11.46. We had Pfizer, $12.73. We had Avery Dennison, $7.44, and then we had Main Street and Realty Income. Now, these two positions right here, Realty Income Corp is a real estate investment trust, and then we have Main Street Capital. It's a BDC, so it's another monthly paying company. It's not a REIT. They operate a little bit different than a REIT, but they still pay out a very high yield. So those two together pay out roughly, $14, $15 on a monthly basis. Pretty nice. They're always kind of padding the monthly line. Then we have Waste Management paying out $5.91, followed right behind by Stanley Black & Decker for $4.52. And then Lockheed Martin, $14.46. So the grand total here comes out to $79.80 that were paid out in the month of June. So right about $80. Now, if I go over to trackyourdividends.com, this is a completely free site that anybody can use. I can see that I was expecting roughly $98 in dividends coming in, but what I received was roughly $80. So somewhere along the lines, I missed a little bit of dividends getting paid out. And what's nice here is they have a stock payout calendar. So here in June, looks like I was expected Avery. I did get paid out by Avery. I saw Johnson & Johnson, Lockheed Martin, Main Street, Realty, Pfizer, Siggy, Stanley Black & Decker, and Waste Management. Those were all positions that I saw, but I didn't see DLR getting paid out. So generally, M1 Finance is sometimes a little bit slow on receiving dividend payouts. But if we were to add in that expected dividend payout from DLR, $15.53, that would bring our total dividend income to roughly $95.33 for the month. So that sits pretty accurate as far as our total amount of dividends that we would receive in a month. So that is fairly accurate in the total amount of dividends. So $95.33 is roughly what I'm expected to get paid. I'm sure that DLR will come in here. It always takes a little bit, and then it'll get announced like, hey, you also received DLR payouts on the 30th of June. It just didn't show up here. It'll kind of come out on the monthly statement. So that is the dividends that we received right there. Now, jumping over into our trading. Now we can look at trading. We only bought 3 times this month on the early portion of June. We skipped the month. We skipped the week in between, and then we purchased on June 21st and on June 27th. So the very first time that we purchased anything, we began to add more to waste management. It was going into the red a bit. We took that opportunity and continued to dollar cost average. Right around that time, JP Morgan also began to kind of tank. You know, we saw JP Morgan in the month lose double digits, so we started the average down on JP Morgan. During that time, it did kind of fluctuate a little bit, and it kind of went green for a small time, and it's kind of negative right now. But IIPR also jumped off that cliff and just kind of kept sinking. And so we added a little bit into IIPR. You know, we're thinking long term. I think this is kind of the riskiest play within our portfolio. And then waste management, we're kind of adding equity into that, $73.32. So that is all of the dividends that came in and the companies that we purchased this month. So taking a look at our total positions here, I don't know if we've ever kind of covered all of the positions that we're currently invested in, but we do have about 30 positions. The fastest way to find this out is just kind of copying this link right here and kind of pasting it in to the window here, and it kind of shows you, okay, hey, this portfolio has 25 holdings. The dividend yield is roughly 2.9% if you were to buy back into this. It does not have an expense ratio. Based on if you were to buy this portfolio on a monthly basis, you'd be down roughly 5%. If we take a look at the S&P 500 over the 1 month or the 1 year, let's go take a look at that. Down 11.92. The Dow Jones down 10.8. And the NASDAQ down 23.96. So this portfolio on a yearly basis, the performance here wise, down roughly 5.04%. So it's very conservative the way that my positions here, you know, waste management being one of the newer positions, but still, looking at it 1 year back, the way that it's kind of set up, you still would be negative, but you wouldn't be negative as much. So that would be since June 28th, 2021. So yeah, that's where this position portfolio currently stands. So buying it right now, it would yield about 2.9% versus my current yield on this portfolio. My yield on cost is roughly 3.21% yield on cost, and my annual income based off the positions in this portfolio is $1,217 in annual dividends. So pretty happy with where this portfolio is currently at. So if you guys are interested in checking out the positions in this portfolio or would like to see my pie, I will have a link to my pie down in the pinned comment down below. So check it out. If you guys sign up for M1 Finance through this pie, you and I both get $10. So if you guys are interested in checking out M1 Finance, definitely do that as well. Now, the third part here, let's see, we've gone over overall, we've gone over the monthly, and we've done the activity. Okay, so let's go ahead into the final area, number 4, the overall thoughts over the next few months. You know, there's a lot of stuff that just hurry up and wait for. That was a big term we use in the military, just hurry up and wait. You know, everyone's in a hurry, but we can't go anywhere because we're just kind of waiting it out. And that's what the market's doing right now. We don't know if we've hit a bottom. We don't know why we should go and recover from here, right? There's nothing showing us why we would make any sort of recovery to the upside. There's more reasons for the market to go down than up. We're waiting for GDP numbers to confirm whether we're at the start of a recession. You know, we've already had 1 quarter of lower than expected, and second quarter will kind of confirm the early portions of recession. It doesn't fully confirm that we're in a recession, just that, hey, stuff is beginning to kind of weaken. Earnings season is also going to begin to come out, so we're going to see financial companies release their earnings. Are they going to have to lower guidance? Is earnings going to come in lower than expected? Revenue is going to come out lower than expected? Guidance is going to begin to get lower. I don't think a lot of companies in the S&P 500 have fully, guided much lower than where initially I think they were planned for 2022. But I haven't looked at any sort of report myself for that. But GDP numbers and earnings season, that's going to play a part over the next few months. And we just don't know what's kind of going on globally, right? So I think there's still a lot of things, a lot of things on the table that we have to take into consideration. And there's really nothing, like if you were to look at the market right now, 50-50, and say, hey, do you 50% chance believe that the market will go higher or go lower? And you list your reasons why the market will do one or the other. There's much more reasons for the market, 51% more reasons for the market to go lower versus 51% more reasons for the market to go higher, right? It doesn't have to be much. It just has to, you start at 50-50 and you list off your reasons. And if there's that single 1% reason why the market will go lower, that's where I believe the market will go. But I don't know if it'll go too much lower. I still think that the market should fall, say, roughly another 8 to 12% to kind of relieve a lot of tension out there, and stocks being so overpriced. But who knows? Who knows what's out there in the market? That was kind of like the headline of my last video. Can we break the trend? And right now we're trending in this downwards direction here over the past 1 month. This is the S&P 500, the Dow Jones, and the NASDAQ here. Kind of looking at, actually we can go ahead and do the year to date, and we'll go ahead and just look at the trend here, right? Year to date, we fell off a cliff in May or January, sorry. And they're like, hey, no, we're good. We bounced, we're going to be good. But that was that lower bottom. And we bounced, but we didn't quite make it up. And then we kind of trailed and did the exact same pattern, right? We kind of trailed over the past month. And we hit what looks like another bottom once again. And we had a lower double bottom. But we bounced off once again. Didn't quite make it back to these highs, the previous bounce highs. And then we did the exact same pattern down once again. Here, we're not like too much of a lower low, but we didn't quite recover again back to those previous marks. And, the thread's getting kind of lower though. It's the column of how fast it declines, and it increases, then it declines even further, and it increases about halfway. Then it declined a lot here between April and June, right? That was that big, where most of the losses took place here in the market. And right now here towards this portion, it does look like it's beginning to kind of slow down. It fell down. We kind of didn't fully recover because we're like, hey, why are we even investing at this point? And the market dropped off again. We really don't know. There's really no signs whether this is going to kind of hold. Every pattern that we've kind of seen done like this beforehand, it just kind of gave us a little bit of, what did I call it? I don't think I even said it. I don't think I said, the fake out, is it another fake out? Or, I still think that there's more reasons to be negative in the market versus positive in the market. So we're going to probably see this trend for a while until everyone's like, okay, no, the market cannot go any further down to the downside. There's absolutely no reason for it to go down anymore. All these companies are beat up 50% or more on sale, but their earnings are just continuing to rise. I think there'll be a point. And this isn't the point right now where we're at, where you want to say, hey, I'm not going to invest anymore. Because if you look at this on a 3-year time frame, we're back to some of these. We're not quite back to 2020 highs. We're not anywhere near. Yeah, we're kind of near there, right? How can I do this? January 29th. Let's go ahead a year to 2020, and let's look at January, and we'll look at, I think it was around the 26th. So let's just say Sunday, right? So here we are. Looks like it was a little bit further ahead. It may have been in February. Let's go to 31st. Yeah, it looks like it was in February. So I'm trying to get as close as that date right there. So it looks like right around February 10th of 2020 was when the market essentially peaked right there. We didn't get a whole lot more, but you can see how much more, how higher we are still from those 2020 all-time highs. And there was a lot of fear in the market then saying, hey, we're going to crash. And we did crash, but we're still, S&P 500 is in the purple. It's still up 18.23% off those all-time highs back on 2020. The The NASDAQ is still 24.2%. The Dow Jones is still up 11% as of those all-time highs back on 2020. But if we lost it all, I mean, we can still fall down into the 2020 bottom here, and that would still be another, what, 30% downside from where we're at right now. About there. I don't know. Let's see here. Let's go ahead into, say, May. And let's do that. I think I have to, yeah, there we go. We have to pick a date. Let's go ahead and go for May 10th. Okay. Interesting. But that is going to be it for this video. I don't know. What do you guys think? Are we still in a channel downtrend to the downside, or do you think there's any sort of recovery positions out there in the market? I don't think it's a bad opportunity out there in the market to invest. I think there's definitely opportunity out there. If you're taking a look at the market here, there's a lot of opportunity to just kind of look and buy. And if you're investing over the next 10, 15, 30 years, there's a lot of potential deals. You know, Microsoft, Apple, Google, Amazon, companies like those, brand names that they're not going to go out of business anytime soon. And this little blip in the market today, it'll be like another blip in the market you saw years and years ago. If we look at the 10 years here, these little blips will take place, but over the long term, companies will continue to raise their bottom line, their revenue. They'll continue to raise their net income, and continues to just, continue to move to the upside. Once we kind of get inflation, yeah, inflation is another one that I didn't include in my whole thoughts ahead, right? Inflation is the main suspect as far as Fed continuing to raise rates until inflation begins to kind of die down. So yeah, inflation, GDP, earnings season, overseas kind of tension. So yeah, there's a lot more red versus green, right? So that is going to be it for me. I hope everyone has a great I hope everyone had a great 6 months of the year and continue to have a great 6 months of the year. Again, if you guys are brand new here to the channel, go down below, subscribe. If you guys have not yet subscribed, don't unsubscribe. Hit the bell to be notified every time I release a brand new video. And of course, give this video a big old thumbs up. Would highly appreciate that. Okay, have a great one all, and I will see you guys in the next video. Bye-bye.